You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
After yesterday's podcast, we have nowhere to go but up. Up from here. Nowhere to go but up. If you didn't listen to Friday's podcast, you missed out. You missed out.
You want to see one of the broadcasting disasters, one of the biggest snafus since maybe the Titanic or the Dukakis campaign. I mean, this was wow.
And it was all you.
Tune in.
And it was all
It really was. I
think you just got back from vacation and went into post-vacation.
Right. It wasn't pretty. Let's just put it that way.
And I actually edited out your worst moments. I kept your better, funnier ones.
I don't believe you for a minute on that one, but okay.
Okay. Hey,
you have the power of the cutter.
Yeah, and it's not even a knife anymore, but I do remember the days. I got sitting out in the garage. I've got an old Revox 4-track recorder with an editing block built into it.
Yeah,
you know?
Slice and dice, baby.
Yeah,
yep.
Man, not anymore. Today it's just like, look at the squiggly green line on my Audition program, which is what I use. I use Adobe Audition. Adobe Audition is great for voice work. People don't use it for music because it's terrible, but it's perfect for radio and podcasts. Thank you, Adobe.
Was that a shameless plug for them?
No. I just wanted to thank them for making if it would quit crashing on my Mac Pro, I'd be even happier, but because it doesn't support multi-threading as well as it should.
There's not enough inside baseball on this show. I've been saying that for years, so keep going. You're doing great here. Really.
Really? Well, Adobe is right there in the Seattle area.
I'm kidding! This is a show about money, not audio editing, if you don't mind.
Adobe's a big corporation worth a lot of money.
Good Lord.
How much? I wonder how much they're worth compared to Tesla.
Oh, please. Yeah, we'll talk about that in a minute.
Hi, everyone. I want to give you a phone number. It's 855-935-TALK, 855-935-8255. That works to call us live on Saturdays from noon to 2 Pacific on Como. It also works to call us 24 hours a day, 7 days a week on our podcast. So use it at any time. 855-935-TALK, 855-935-8255. I read the Wall Street Journal for one reason. Really.
Movie reviews?
No. I move right along because I just don't find, I don't know, but.
Cooking page?
The Wall Street Journal is the third or fourth paper I read every day because I get so much more information elsewhere. But I love Saturdays because we get The Intelligent Investor.
Written by the erudite Jason Zweig.
Zweig. Yes, Jason, thank you so much for your Zweig. And this week, I love this. Did you realize that right now, as of the beginning of April, all of these mutual funds got a clean slate for their 1-year performance that they love to tout?
Well, they're going to be promoting it if they're not already. What we're talking about here is now we've moved past the 1-year anniversary of the low of stocks last spring. So guess what? The 1 year looks Wow, incredible when it comes to returns. I mean, 40 mutual funds reported total returns of at least 100% over the last year. 59, exchange traded funds over 100%. Now
for the mathematically challenged among you, 100% return means a double in a year.
Yeah, it's a lot of money. I went back and looked at if you just held a diversified 100% equity or stock portfolio
globally,
big, small value, globally, low cost, you'd have made about 76%, 75.9. And if you've been in a portfolio, more likely for our listeners, 60% in stocks, 40% in bonds, you made just shy of 38%. But what do we make of all this?
38%.
Paltry, barely worth putting your money in the market. I mean, but what do we make out of all this? Because, yes, you're going to hear more from these funds that have made huge returns over the last year. And what should you take away? I'm going to give you my takeaways.
Okay.
Because this is what I believe after all that.
I figured
right? I believe.
As the co-host of the show, that was your job.
I have a few things I'm going to say because Mark Hulbert, our friend and regular writer at Market Watch, wrote recently that if history is a guide, the rest of this bull market won't be as great as what's been past. Nobody knows that for sure. But here he wrote something in there that I do believe. Going back to 1793, which is further back than even Don can remember, the 6% real rate of return. 6%, that's after inflation, right? So
right.
I believe that.
Right.
I also believe there'll be some managers that will make more.
Yeah.
But I do truly believe that you should diversify, and keep your costs low. That's the things I actually believe.
Oh, my gosh, there's a message. 855-935-TALK. Give us a call. We'd love trying to help you.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
You should count your blessings, all of you listening right now, that you are listening to the radio and not watching us on television. Because, you know, the one thing that's worse than old bad dad jokes, it's old bad dad dancing.
That was bad dancing. I admit it. I fully admit it. Yeah. Well, I don't dance very much anymore, so I'm out of practice. It's only been like 50 years since I've really danced much, so you get it.
What was that? Your high school prom?
Probably. Yeah, probably.
Okay, that really doesn't count because that wasn't dancing. That was just you dating. 855-935-TALK is our phone
Neither
number.
of which anyone should see on this show. You're right. Thank you.
8255. I'm Don, that's Tom, and Michael's on the telephonic instrument. Michael, welcome to Talking Real Money.
Hi, guys.
Hey, what's up?
Yeah, I have a tax question.
Oh, no. I hate tax questions.
Go for
ahead.
it, man.
Go ahead.
Yeah. Okay. Can you guys tell me the formula or do the math yourself? If I have a stock that pays a 10% dividend, but it's non-qualified, as compared to a stock that pays a 7% dividend, but which is qualified, so the 25% effective tax rate.
That's, I'd go get my daughter because she's really working hard on the algebra right now. Maybe she could run that. I don't know.
You have to run. You got to know your bracket. You got to
know where you are.
You got to know a lot of stuff. We got a lot of variables here in the wonderful, wild, and woolly world of taxes. But let me tell you something. Buying stocks for dividends we think is a huge mistake, qualified or non. Because, by the way, if you have stocks that are paying 7 to 10% dividends, I'd look carefully. Yeah, there's something wrong. There's something seriously wrong somewhere.
Either the price has gone down a lot, or somebody's really trying to get you interested.
Games.
Yeah,
I mean, if those are real numbers, I'd be really scared, Michael, of those stocks. I wouldn't want to touch them with a 20-foot pole. So, figuring out the tax liability on them, no, that's something you're going to have to actually do with an accountant who knows your personal situation. You got to know your tax bracket. And my guess is that if you're in a higher bracket, it looks to me, first blush, like a wash. Thanks for the call. 855-935-TALK. Susan, you're next. Welcome to Talking Real Money.
Hi, can you hear me?
Absolutely.
Yes.
Great. I recently sold my home, which I'd been trying to get rid of for years and was able to sell. And I am in the middle of an estate situation where I'm going to be getting some money. And what I did with some of the distribution that I received is I did buy a home, and then I recently sold my other home. And I do have about a couple $100,000 in my state retirement, and then I'm keeping the estate, the IRA and the Roth IRA. I'm going to keep that came from my father's death, and that's a couple $100,000. And what I want to do is buy another property because I'm going to end up getting a large chunk that I can combine with the proceeds from the sale of my house, which is around $200,000. And I kind of want to go a little more in the real estate arena versus stocks and kind of that investment, but leave what I have. But what I'm doing is I have Vanguard. Some of it's in Vanguard, some of it's in Merrill Lynch. And then I'm talking with a financial advisor at the Washington State Employees Credit Union. Just because I really, I don't like.
We're waving our hands. We're waving our hands.
Huh?
Yeah. Let's do one thing at a time here. Yeah. Go ahead.
Where I should be going with this, because I do make enough money to pay for my living expenses, and I don't have a mortgage now. So I want to know where to put my money, kind of generally, with little experience.
Okay. Well, first off, there's a lot of stuff going on here. Second, and I think this is where Tom's going to go. This is one of those questions where the cart is figuratively before the horse. How you invest it matters less than why you do it.
And how old are you, Susan?
I am 58.
Okay. So tell us, I think I heard through all that you sold a house and then you bought another house. So you have a place to live, correct?
Yes.
Okay.
And no mortgage.
And so the other real estate purchase you're talking about making would be as an investment property of some kind to get a return on it. Am I correct in assuming that?
Yes.
Okay. Good. That's helpful. Because
can we throw one more question?
Go ahead.
About that?
Yeah, go.
Why?
Please.
Why do you want a piece of real estate? What is it that's driving you to have that as one of your choices?
I feel that, at least in my life and my parents' life and my grandparents' life, the real estate was a much better investment in their deaths. I mean, there was so much more money through purchase of real estate. But also, I'm looking at the second property would be kind of like a vacation property that I would also use.
Okay, now that's an that changes this. This is why the why is so important in all of these equations.
Yeah. So I would separate those two things. First of all, in the lifetime of your parents, unless they got extremely lucky, the return of stocks has been greater than the return of real estate.
If they had actually invested and not played
which they
the
did
market.
because you inherited an IRA and a Roth. So the return on stocks has been better than the return on real estate. Sometimes it doesn't feel like it for whatever reason. Okay. Number two, in today's world, the only reason, unless you want to get in the business of managing real estate, I would not run out and buy another property because at 58, you're going to be tying up a lot of your capital that you may well need in the next few years if you decide to retire. This would be well down the list when Don was talking about putting the cart in front of the horse. You got to have a plan first to say, I'm 58, I'm going to work this many more years. Here's the income I'm going to need when I quit. Where's that going to come from? That would be part one. Then I would get into how to invest that money.
Yeah, this is where when you said, I've been talking to a financial advisor at the credit union, I made a little squeaking sound. The reason is I didn't spring a leak or something. The reason is most of these people are not financial advisors. They are product peddlers. Did the financial advisor with whom you met, did they start the conversation with questions about you, your needs, your fears, your future?
It's a credit union. It's not.
No, I know. It's credit union. Credit unions have terrible, terrible financial advisors inside them. Terrible.
Okay. Good to know.
And let me explain why. Yeah, let me explain why. Because Don used the term product pushers. They are truly non-fiduciary advisors. The only fiduciary relationship they have is to the firm that they work for, not to you as the client. So we see a lot of bad stuff that comes out of people that go into a credit union or bank for that matter and trust the person across the desk they're talking to.
We believe that everybody should sit down with a fee-only advisor for at least one meeting and find out what it's like to talk to somebody who's really trying to look out for your future and building a plan.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
It seems to me this is probably the number one thing we get asked on this show is, I got some money, what do I do with it?
It always is.
Yeah.
People want to know what's the easy, I just came into this money, but you got to step back. You got to start with the plan part first to say, here's where I am. Here's where I'm trying to get to. Put all that together, then you figure out the investments. And I'm not a fan of going out and buying real estate unless you want to be in the business of managing
although
it.
she did say something. She said,
Yeah,
as a vacation home.
But even then, I mean, I just got back from spending a week at a rental home in the Scottsdale area. You can go stay wherever you like and then walk out the door and say, here, well, not the keys anymore. Here's the keypad. And that's the end of it. I just think, I don't think there's a reason to own rental property that way, the way there used to be. It's too easy to find what you want, where you want to go, and go do it. That's my take.
855-935-TALK, 855-935-8255. Give us a call. We want to help you, but we want to help you in the right way. And that doesn't always mean giving you the answer you want, but instead giving you the answer you need. Nancy, you're up next. Welcome to Talking Real Money.
Hi, I have two questions.
Hi, Nancy.
I'm retired, 78 years old, and all of my mutual funds are with Vanguard. And I'm wondering if I should transfer the mutual funds to ETFs because it would be more tax efficient.
Maybe.
These are in a taxable account?
Yeah. Are they in a taxable or tax-deferred account?
Well, most of them are in a taxable account. Some of them are in my IRA.
How in the taxable account? How long have you owned those mutual funds? Just guess.
Years.
Yeah, there's the problem.
So here's the issue. And by the way, some dimensional funds, for example, pretty fascinating. They are actually with a lot of their taxable mutual funds are just going to be, you're going to wake up one day and the money's going to be in their exchange traded fund with no tax ramification. But what Don's talking about here, Nancy, is if you said, okay, tired of being in mutual funds because I can be more tax efficient and have a lower cost at the Vanguard exchange traded funds, you're going to have to pay a big capital gain on the amount that you purchased them for versus what you're going to be selling them for. So it wouldn't make sense. Part two of that, I don't see any reason in a qualified account like an IRA, except for perhaps the difference in cost in running out and selling the Vanguard mutual funds in the qualified account and buying the exchange traded funds. There's going to be a few basis point difference in terms of the cost, but I don't think that would be enough to make that change there. And so going back to your situation, you would have to very carefully look at what you could sell before you moved yourself into the next tax bracket, all those kind of and do you have the money to pay the taxes, et cetera? I don't know if that makes a good financial planning sense for you.
I agree. And here's the thing, Nancy. The fee differences between, for example, the Vanguard Total World Stock Index Fund and the Total World Stock Index ETF, the difference is 0.02% in fees. And because both funds are indexes, they do distribute dividends. Those are taxable, but most of the capital gains at the Vanguard Total World Stock Index Fund are deferred. They don't trade a lot. They don't move a lot of stocks. So therefore they don't realize a lot of capital gains. So you've got a lot of deferred gains that you're going to get hit hard on. So I would say if you want to own VT instead of VTWAX going forward, great. That's fine. But until you've sat down with your accountant and figured out what the bill's going to be and how many decades it's going to take you to recover that loss. And I don't think it'll happen in your lifetime. I wouldn't mess with it.
Okay, and my second question is, the customer service at Vanguard seems to be decreasing, and I'm thinking
oh my gosh, yes.
From Vanguard to Fidelity. They have an office in Bellevue, which makes it easy. what do you think of moving from Vanguard to Fidelity, moving everything over?
I don't think anything will be different, for one thing.
Yeah,
I think big corporations in America stink. I will say it publicly. Horrible. I've had a horrible experience with Bank of America where they've 3 weeks, still no response. I don't think it's going to be any better moving. Here's the thing you should consider. You want better customer service and personal help. I think a local registered investment advisory
cost
firm.
More money.
That's going to cost a little bit more, but you're going to get the help. And by the way, at 78, you may need it sooner than you think. No offense, but that's something to consider.
And you just have to expect that the service levels are going to decline pretty much everywhere.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, vestory.com.
Reality radio for a really great future. We're talking real money.
Well, let me give you the number again, because I know you have questions, and we want to give you the answers, but we want to give you the good answers, not the bad answers. You get enough of the bad answers from everybody else in this business. 855-935-TALK is that phone number, 855-935-8255. You can call that number 24 hours a day, 7 days a week.
And this is a good time to do it because there's nobody in line ahead of you. So you'll be right there, and you can hassle Don with a very difficult question.
Absolutely. Now, we were talking earlier about how now the 1-year return for almost any equity portfolio looks pretty impressive.
It looks better than pretty impressive. It looks dynamite, blockbuster.
I mean, really, can you ever remember? Think back. I want you to think back. Can you ever remember a single year in which a massively diversified, really like the Vanguard Total World Stock Index, where a fund like that isn't just focused in one segment of the economy but owns pretty much everything, has been up more than 50% in a 12-month period?
I cannot. And by the way, remember, if you put in the tilts to small and to value, you're up over 75%.
Absolutely.
In 1 year?
I'm just talking about the dull, boring, plain vanilla stuff. 50.
I cannot remember that.
I don't ever remember it happening. I have been in this business since 83. Gosh,
counting your broker time before you went straight.
And I've never seen it. This is so unique. So instead of being pleased, thrilled that part of your portfolio is doing really, really well, no, instead you focus on the part that isn't.
It's a fascinating thing because we have a tendency to look at our money and say, well, that part of it's made a lot of money, as you just pointed out, Don, and this part over here's lost money. But I got to fix it so everything's making money. I just want the
winners. I don't want any losers.
Get rid of the stocks that go down. You don't want to own those. But what I'm talking about here is bonds, fixed income, which year to date are, for the most part, losing money, have lost money. Always need to be careful to talk about the past tense when it comes to securities. The DFIGX, the Dimensional Intermediate Term Bond Fund, down a little over 4%. So I took a couple of calls this week, one from a client, one from somebody else who said, wait a minute, I've been looking at my portfolio. The stock side is making huge money. The bonds are down. Should I be selling the bonds and buying the stocks? And I said, okay, now I want you to think that through.
There's a tense issue here, too.
There is. You want to finish that part? Go ahead.
Well,
but
yeah, you're saying are down. They're not down. They're not. They were.
They were down. They were down.
8/10.
So, okay, first of all, think that through. Do you like to sell things after they've gone down and buy things after they've gone up? Generally, that's poor investment policy. You want to do the opposite, actually. Sell the things that have gone up and put the money into the things that have gone down. Number two, not all parts of your portfolio are going to make money every time. Let me repeat that. Not all parts of your portfolio are going to make money all the time. It's not going to happen. I'm sorry. I wish it was.
Wait, does this mean that if you're rebalancing regularly, that it's probably time to sell those winner stocks and buy those loser bonds?
Yeah, and you can remember a year ago we were telling you to do the opposite, right? You were selling bonds that had gone up by 10% and buying stocks that were down 35%. I know, it's counterintuitive.
And people were saying, no, it's right. March. Please do not buy me stocks. Yeah. Do not.
Exactly. And how did that turn out? Well, rather well. Let's just put it that way. We see the aforementioned 100% plus returns of some mutual funds. By the way, U.S. small cap value up over 100% in the last year. So you did the right thing. But okay, so no, you should not be. And by the way, your bonds, when you're talking about losses, a 4% loss, is that catastrophic in some way? When you compare that to stocks, as we mentioned, went down over 30% in like 28 trading days a year ago. No comparison in the decline. The bonds are there to be the cushion, to be the ballast. Have they gone down a bit this year? Yeah. For a variety of reasons, one of which, of course, is interest rates have gone up. So, no, I would not be selling bonds. If I was doing anything, I'd be selling stocks and buying bonds. And your bond portfolio should be part of your portfolio for the aforementioned reason. It's there when stocks go haywire, when they go down, as they may any soon, according to Susie Orman.
Yeah.
So,
well,
I mean, the thing, you don't want to be selling
when
that
are we going
for
to
the
stop
reason they
listening
went
to
down.
Susie Orman?
Because they put it on my phone every day. I come in and she's got to
I mean,
quote
for example,
about something.
let me put things in perspective for you. You're talking about bonds being down. Folks, 12-month return for the Vanguard Total Bond Index, a loss of 3%. 3%.
Not 30.
That's stability. That is actually showing you stability. Your stock portfolio, if it's 100% stocks, at one point would have dropped 50%. 855-935-TALK.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Hi, I'm Don. That's Tom. We talk real money. We do it almost all the time. We do it every day. We just talk about money a lot because, well, we want to help you deal with it better because, really, on average, you're not doing a great job. Not necessarily your fault. There's a lot of people out there misleading you, saying things that really shouldn't be said. Matter of fact, stop watching CNBC, stop watching Fox Business, don't read Investors Business Daily, rarely look at
Barron's.
Don't read Barron's. 855-935-TALK is our phone number, 855-935-8255. You can call us, or you can send us questions at talkingrealmoney.com. Click the contact form, and people really like sending questions that way. We get more written questions than we do called-in questions, at least to the podcast. And since we get so many of them, we need to get a few of them out of the way because we're like, what's the date? Oh, we're a week behind.
10th.
We're a week behind
April.
on our questions.
Yeah.
So
Okay.
we better get to it. You ready? And this one, coincidentally, is the next one in line. I don't pre-screen these. This is the next one in line. The subject is bonds. Isn't that amazing? What a
No,
coincidence.
that's a shocker, Don.
Yeah.
Very much so. So go ahead.
Please help me understand bonds and bond funds. Prior to March 2020, I considered bond funds to be a safe portion of my retirement portfolio and never gave them much additional thought. In the past year, however, there has been a lot of background noise surrounding them. I hear about how they are very expensive for the very little return they currently offer, how they have massive interest rate risk right now, and about how they have nowhere to go but down, Tom.
But, okay,
Down.
let's
I'm not
answer
done
one
yet.
question first.
All right, go ahead.
Oh, pardon me.
No,
You're pointing at me.
No. I just was.
All right. Well, will you please look up the expense ratio for the Vanguard Total Bond Exchange Traded Fund? So we'll give you that number.
You mean? Oh, well, that was an actual.
Because you said they're very
request?
expensive. You said that it's very expensive to own them.
Okay,
It's,
the
I'm gonna-
bond BND, the bond market
Yeah, BND.
ETF.
Yep.
BND has an expense ratio
Yeah.
0.035.
I mean, so okay. So let's dispel any rumors that it's expensive.
Wait a
to own
minute, that's
bond
35
fund.
1,000ths.
Yeah, I can't even do that with $100. I don't even know what that is. That 3 cents? I don't know what. It's not a lot of money. So you can own a lot of bonds, and they own them for you, and they manage them for you, and they buy the new ones, and they get rid of the other bonds mature. Okay, number one.
There's some more
Let's
questions.
go back.
Well,
Yeah,
you want to go to the
well,
rest of the
okay.
question?
Well, I just want to answer first what a bond is and what
Oh,
the
okay, that's
difference
good.
between that
Because
is a stock.
that's a good thing to do. I'll give you that.
Bond is an IOU.
Right.
A bond, so there's a piece of paper that says the corporation or government entity will pay you back. You're loaning them your money. They will pay you back your principal plus a certain amount of interest in a period of time. There's a maturity to all this, right? It comes to an end. That is completely different than owning a stock. A stock is ownership in a company. There is no such guarantee, period. Now, when it comes to bonds, there's more risk in owning ones issued by corporations, right? Because sometimes those corporations have bad days and they can't pay you back. So far, the U.S. government's always given you your interest and the return of your principal.
That's a guarantee.
That help?
Yeah, and here's the thing. Bonds, in and of themselves, don't have any interest rate risk at all if you hold them to maturity. If you buy a bond, a government bond, if you bought a government bond 10 years ago, and it was a 10-year Treasury note, and
which probably was paying 5% or something.
You bought it at the issuance, paid $1,000, held it for 10 years. The end of 10 years, the government gives you $1,000 back plus all the interest they have been paying along the way. So the risk is in just intermediate short-term volatility based on people buying and selling bonds to one another. That's why bond funds fluctuate. Now on to the rest of the question. Specifically, my retirement plan through work offers Vanguard Total Bond Market Index Fund, and this is where I keep all of my bonds. I was perfectly happy. with the strategy up until the last year.
Really?
I started hearing about the inherent risks of bonds, Don. My retirement plan also offers the Vanguard Short-Term Bond Market Index Fund. Is this a better place to keep my bonds? I've heard claims that the short-term bond fund will mitigate factors like interest rate risk and is safer right now. This is for money in a retirement plan that I don't expect to touch for at least 20 years.
Yeah, I mean, that's a great question. Okay, so let's answer the split. You could have 70% of the bond portion of your portfolio in the intermediate term. That would be the Vanguard total bond. And then 30% in the short term. That might cushion the blow a little bit. Not going to make a lot of difference in the long haul. The bonds, as we said, are there for the ballast. The bonds, a 3% loss in 1 year is really something to think about? I don't think so. If you do, you're not looking at investing properly because stocks, as Don pointed out last segment, can go down 50%. So there's no comparison. Number 3, Vanguard did a very fine paper that may be out on the internet somewhere about looking at the worst of times with bonds, which I think was the 93, 94, somewhere in there. It took a very short period of time for those bond funds to be positive again because remember, the Vanguard bond fund is buying new bonds that are being issued now. The 10-year is trading at, 1.6 or whatever it is. So they're buying new bonds with the higher rates that over time will supplant those bonds that are paying the lower ones. And so the amount of interest will go up over time. I think you're very fine to have some of the bonds. And by the way, not much if you're really working another 20 years, 20% in bonds, 30%, depending on your personal makeup.
Here's the problem.
Your emotional wherewithal.
You're overthinking it. We do this. It's a human frailty. We overthink. We think that this is more complicated than it really is. The key is, you want to save yourself a lot of grief? Stop listening to what you called, and rightfully so, the background noise surrounding them. Stop listening to the talking heads on TV saying, bonds have nowhere to go but down. They have nowhere to go but down. No, they go down and then they go up and then they go down and then they go up. But it's only by little tiny movements. It's not the big movements.
There's been other discussions about the fact that the spread now between junk bonds, which are bonds that are issued by riskier corporations, riskier municipalities, are paying interest rate of only about 3% more than the safe government bonds. And what does that mean to the future? Don's right. You don't want to look at any of this stuff on a day-to-day basis because it'll eat you alive. Number 2, go back and look at the people that told you, here's what has to happen with either stocks or bonds. Jim Cramer comes to mind. Susie Orman comes to mind. Here's what has to happen. And 9 times out of 10, it does not happen. No. So it is no reason to make a move based on any of that, what I can only call conjecture.
No kidding. The Vanguard High Yield Corporate Bond Fund has a yield, this is the past yield, of 4.6.
Yeah, so that's very close to.
VT has a.
Well, no, VT is the stock fund.
Oh, not VT. I meant
BND.
BND.
Probably has a yield of 1.5. Or a little less than that, maybe 1.2, something like that.
No, the 12-month yield there. 12-month yield there is 2.2. The SEC yield is 1.3. So you're right. The spread is less than 3% between junk and high-quality paper. That means
this is nothing to get into. I wouldn't think about it at all if I was owning bonds.
No,
that's not the reason.
It just means
it.
People are stretching for yields. They're bidding up the price of junk bonds, and that really concerns me. 855-935-TALK.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And one of the things we do is we talk about real money in classes, and we haven't done an online class since Retire Meet in February, but we figured it was time. And since the IRS has given everyone a reprieve and you don't have to file your taxes until May 17th, we have a little bit more time to give you a class on taxes. But it won't be of much help this year, but it will be of help going forward. It's called Real Investing, Less Taxing.
The basics about how to invest your money to pay the least amount of taxes. The basics about maybe doing a Roth conversion, maybe not. The basics about why exchange-traded funds might make more sense than mutual funds. All of those things you need to know about really any time you're investing.
Sign up at talkingrealmoney.com, talkingrealmoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.